Sounds like you've got a pretty good, pretty strong financial economics thrust to your campaign and perhaps to your knowledge base.
Well, right. That's kind of what got me interested in running for office in the first place. Also was monetary policy and what's happening to the dollar. And a lot of things that are happening right now are actually not really in America's favor. For instance, also on the website, there's an article called on the front page called "The FDIC is Bankrupt," and what that refers to is on Friday, the FDIC started in 2008 with $53 billion in its DIF fund, which is Deposit Insurance Fund, and over time it's depleted. And on Friday, there was a Colonial Bank closed in Alabama at a cost of about a little bit over $2 billion, and that completely killed the rest of the account. So technically, their insurance fund is out of money, and that fund was built up over decades of time of taking out small fees from the banks. And now it's gone. The government does have $100 billion slated to basically a bailout is what it is to bail out the FDIC. But there hasn't been, I've been watching very closely, there hasn't been an announcement as to exactly, there hasn't been a formal announcement as to what the government is actually doing about it. And in some respects, you can kind of appreciate that because this is, the types of things where people might get a little nuts and go out and do crazy things like take out all of their cash. So that's something to be very aware of.
A veritable run on the bank, huh?
Correct, but, another thing that's also, there's a lot of things actually on the website, but there's a couple articles. One is Fractional Reserve Banking in Pictures with a downloadable PDF if anybody actually wants to take a look at it. But it's actually one of a two-part series, and the second part of the series is actually called Yes, Virginia, There Are No Reserve Requirements. And in that article, I outline the case as to why there are no effective reserve requirements in the banking system. There's an accounting trick that was implemented back in the 90s called deposit reclassification. And what that did was it pretty much got rid of banks could manipulate their reserve requirements at any point. And at the start of the banking crisis, I estimated what the actual reserve rate was, and it was less than 1%. Not because a lot of folks that actually do know what fractional reserve banking is, the number is like 10%. Then
that's traditionally what it's been, or at least nominally.
Yeah, so what happened after that was they added about $800 billion to the monetary base, and without auditing the Fed, and I know on your show you've had also like H.R. 1207, Ron Paul's bill to audit the Fed, and Senate Bill 604 to audit the Fed. Don't quite know what happens, but the bailout was roughly $800 billion, and the amount that they added to the reserves and also to the monetary base was also $800 billion. So what I make a suggestion in the article is perhaps this is, pretty much what did occur, and I show everything in the article is a source, so anybody can go take a look at the website and decide for themselves whether I'm correct or not, and I'm pretty sure I'm correct, but the proof is all there.
Well, good. It sounds like unfortunately, it sounds like that's a little deeper than the average voter wants to get into it. But, this show and this network is dedicated, part of the cause that we are dedicated to is honest money. And we have been trying to reveal for years, and even before I found this show, I've been going back 27 years, I've been trying to educate people. But I don't think anybody has done more educating than Ron Paul through his campaign here the last couple of years. All of a sudden, it just seems like people, even working people, relatively unsophisticated people, finally get it. They make money out of nothing. Don't you think?
Yeah, I mean, what it comes down to is, think about it. Like, if you have a very good job and you work your butt off for your entire life, if you're lucky, you might make, let's just pick a number, $2 million.
In your lifetime?
Your whole life let's just pick a number. So you work your whole life, you get this $2 million. The government, of course, is taking about half of that in taxes and a lot of the rest to inflation. But what's so fraudulent about this is, right now, if the Federal Reserve wants to create that $2 million, they can do that with a couple clicks of a button.
Yep, and electronically.
Right, and that's the key part of the article that I point out, is what we're really down to now is a paper ticket system. There's nothing really scientific or anything about it at this point in time. All it is just, we have these paper tickets. They still have purchasing power because they have, number one, they do have a certain degree of scarcity. Number two, they also have the faith of people in it. People believe that these slips of paper actually do have purchasing value.
And of course, there's always the full faith and credit of the United States government that stands behind that debt.
Right. I think that's the same slogan in the FDIC insurance fund.
Yeah. Well, one thing that has kind of bothered me about this FDIC thing, okay, now we had this financial crunch, and I'm not sure even how old you were when we had this same crunch back in the 70s with the savings and loan crisis, but as a result of that, they went from guaranteeing deposits $50,000 and down up to $100,000. And now this crisis hits, and just when there's going to be the greatest raid in decades on the FDIC fund, they increased the benefit to $250,000.
Right, but my point, the point that I would make here is that the FDIC insurance is not really insurance in the particular case. I mean, all it does is it basically acts to give people faith in the banking system. If you go and read, there's a book that Murray Rothbard wrote called The Case Against the Fed. And if you read that book, there's a section where they go over the FDIC insurance and basically how it is fraudulent. There's number one, it's not an insurable case, and number two, all it does is it keeps people from basically losing their money. Like if you know there's a possibility that you'll lose your money, you'll be very careful with the bank that you'll be investing with. You want to know its reputation. You want to check out its balance sheet. I mean, people these days don't do this type of thing, but that's what you would actually do if you were very concerned about it. Or you put your money into a deposit box and use the bank as like a storage house, which is what some people did, especially after the Great Depression hit. And we might be going back to those types of things in the future, unfortunately.
Yeah.
But, so the FDIC, this is my other point, the FDIC itself is a massive failure. They started with $53 billion in fees that they took, and they're already depleted. And we haven't started, this whole bank failures really haven't started. This year there's been like roughly 74 or 72 bank failures, and that's really nothing. There's roughly, I believe, about 3,000 plus depository institutions in the U.S., so it's just kind of a drop in the bucket. But that's what the Fed always was. The Federal Reserve replaced the national banking system that Abraham Lincoln put in place in the middle of the Civil War, and all the Fed did was kind of tie these banks together even tighter. So now what we're really looking at is if the system goes down, every single bank goes down.
Because it's all part of the one system. Say, we're coming up on the break right here, Jake, and we haven't talked very much about health insurance yet, but we will in just a minute.